Management. Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we're talking about the topics that are important to you, your home, your family, your health, and your money. And the following segment is brought to you by Wilsey Asset Management. Now, investors are often drawn into buying hot stocks that get a lot of buzz and media attention. Brent Wilsey's here today to tell you why you need to resist that temptation.
Oh, I'd like that. Resist it. They do need to resist. I've been doing this now for about 45 years. I've been talking about this. I always try to give examples and proof. And I always feel, in addition to running my investment firm, to try to educate people, inform people about investing, about the economy and finance. So these are things I try to do. And so I have another example. It's not the first, it's another example about why not to buy hot stocks.
This is not just an investing lesson. This is a history lesson.
A history lesson, yes. So let's talk about the things that were hot software companies. A few years ago, like, oh, they're going to do so great because of AI. So the prices went way up dramatically. Well, now they're saying, uh-oh, AI may not be good for these software companies, and some of these companies have lost a lot of value. Like, for instance, Adobe, which is very well known, been around for many years, and we look at the longer term return. 5-year return on Adobe, that's a negative 43%. If you invested $10,000, you lost $4,300. Even ServiceNow, which is a great, well-known company, 5-year return, a negative 5%. And then Salesforce, which has been around for years as well, their 5-year return, a negative 16%. Your software companies are getting hit dramatically, and this is why we tell people, don't overpay for these companies, because it's exciting when you go to the party, like, yes, I have Salesforce, and yes, I have this, and you're so boasting and so happy about it.
Don't be a big shot.
Don't be a big shot, because what you've done, you've overpaid for a company, and sooner or later, I don't care what that company is, it will come down, eventually comes back to the mean, is what will happen.
Yeah, we get enamored with these stocks for all the wrong reasons, and then buy at the wrong time.
Yeah,
right?
Those are emotional buys. So that's what we tell people. Don't do an emotional buy. Look at what you're paying for that business, for that company. And then realize, too, what's going to happen 5 years down the road. And what happens is that competition comes in. You may have smaller companies that are coming in. That's what's happening to the software companies now. So smaller companies are coming in. They're taking a little bit of market share. Also, too, the sales growth of these companies is slowing down. I want to say that's a sales growth, not sales declining. The growth of the sales is slowing down. So the expectation that, oh, these sales are going to go dramatically up, well, that's not quite happening. So therefore, the stocks are coming down. Competition, Anthropic, which is very well known now, they have a code now called, what is that, Claude Code, that can build software programs much faster. These complex software programs, they can build them much faster than the software companies. So again, competition comes in, takes that from you. You have to be careful what you pay for something. I try to tell people, you're buying the small piece of a large company. Where's it going to be 5-10 years from now, not 5 to 10 days.
And is it true that the tech stocks, and now stocks that are related to AI technology, are they more vulnerable because we just don't have really a body of evidence to know what's going to happen over the course of years? They're also new.
Yeah, they're also new. And what happens is that people emotionally bid those up. People say, oh, I'm missing out, I better get it. They get into it, they buy it high. I mean, actually, if you bought Adobe like 2 years ago, you're probably down maybe 60-70% because they peaked out about 2 years ago. So you've got to understand that, yes, the technology may be hot, but what about competition coming into the game? What about a slowing down of growth because of other companies coming in? You've got to look at these. I mean, most wealth in our country is made from businesses, but you've got to be smart when you invest in a business. That's all you're doing. Stocks are not a gambling chip. You own a small piece of a large company. So look at it that way. Don't get so emotional. Try to be excited about it. Say, what is the business doing? Where's it going to be 5-10 years from now?
Is this true of what we've seen recently with what they call the Magnificent Seven, too, right? And some of the value of those stocks have declined.
I believe the Magnificent Seven, only 5 stocks last year beat the S&P 500. They're not doing quite as well. I think it's kind of over for the Mag 7. Not to say the company's going bankrupt, but they're not going to have the big returns that they had a couple of years ago. And because, again, they went way up, now the earnings and the sales have to catch up. And that's why I tell people to don't swing for the fences, try to get the home run. They try to buy one hot stock. A portfolio is more important. That's what builds your long-term wealth. As a portfolio of 15 to 16 good quality businesses, they'll do very well over time. But you try to swing for the fences, kind of like when you go bowling and you keep throwing it hard. You get one strike, but all the others went in the gutter. You know, that's not going to do very well.
One strike would be good in my game.
well, that'd only be what? What's a strike? 10?
Yeah.
So, but you're much better, like going a little bit slower. and maybe getting 1 or 2 strikes, maybe getting some spares and stuff, and having a score. I'm not great on bowling. I don't know why I brought that up, but a score maybe 100 versus 10 because you did a lot of gutter balls.
And stay out of the gutter.
Stay out of the gutter. Yeah, don't invest in the gutter either. Don't swing for the fences. I mean, you've got to be careful.
All right. Thanks, Brent. Appreciate it. All right. More information, everything that Brent does is online at smartinvesting2000.com. We'll be right back with more of Good Business San Diego in just a moment. And a reminder, you can watch the show on a Roku TV, Apple TV, or Amazon Fire TV. All you have to do is download the KUSI Fox 5 Now app directly to your TV, and it's free to watch. So download that app now. Get it all on your TV today. Thank you so much. We'll be right back.